All right, I have to update the macroeconomics monetary policy videos to accommodate the additions to the AP macro exam over the ample reserves. So these are notes covering the additions post 2022-2023 school year that accommodate ample reserves in monetary policy. And the reason why we have this is because since the last financial crisis, the Federal Reserve has started changing how we do monetary policy, really kicking off in 2015 and then in 2020, when the Federal Reserve got rid of the reserve requirement, this became the primary focus tool of monetary policy. So what happened is we're moving from what's called a limited reserves to an ample reserve system. Limited reserves is when we have a reserve requirement, the specific percentages banks have to keep in their vault at a time, and the tools of open market operations, the discount rate, and the reserve requirement were the only main tools. And of course, how those affect the money supply, which then affects interest rates, including the federal funds rate. But now that we no longer have a reserve requirement, the ample reserve system needs to be focused on to show how we change monetary policy today. And the key with this, and the only tool of an ample reserve system, is the administered rate. This is the interest rate that banks receive for keeping their money in the vault, which means banks now have incentive outside of just the requirement through the reserve requirement. They have incentive to keep more money naturally in the vault based on what the administered rate is. And overall, whether it's been raised or lowered, we can see here that since they started giving banks interest to keep money in the bank, the amount banks keep in their vault has definitely increased by a significant amount. But it also is a tool of monetary policy, because if the Federal Reserve were to lower the administered rate, banks would have less incentive to keep their money in the vault and more incentive to loan it out instead, putting more money into circulation. So this is what they would do in a recession. They would lower the administered rate. In inflation, when the Federal Reserve wants banks to not give out as many loans, they would raise the administered rate. So they would raise the administered rate so that banks now want to keep more money in their vault and not loan out as much, which would take money out of circulation. Now, with this new system, that is the only tool, but it fundamentally changes how the reserve system works. So we have to cover a new graph to help show ample reserves versus limited reserves. And that is where we have the reserve market graph, which we see here. We have new labels. And this also accommodates another new change that College Board started doing last school year, 2022-2023, that they're moving forward with now. The Europeans call the federal funds rate the policy rate. So College Board has now started taking policy rate and using it interchangeably with federal funds rate. So now you have to know policy rate, federal funds rate can be used interchangeably, and College Board will use both. So this graph has policy rate, but by policy rate, it really just means federal funds rate. And that is not identical to the nominal interest rates on the money market graph, but similar idea, because remember, under nominal interest rates on the money market graph, that includes the federal funds rate. So similar idea in terms of how they affect interest rates, how that affects investment, how that affects GDP, and therefore aggregate demand. So good news with ample versus limited reserves, they both will affect the I of GDP and will affect aggregate demand the same exact way. Now, bad news is this graph is a little complicated. We have three ranges for the demand for reserves line. We have the upward horizontal portion. This is the same exact range as the discount rate. It represents the discount rate. And the reason it's on this graph is to illustrate the highest interest rate in the financial sector, because the Federal Reserve only wants to use the discount rate in the time of an emergency. So they want to show this as a ceiling of the highest interest rate banks will use when borrowing money from the Federal Reserve. Other than that, it's not very significant in terms of affecting monetary policy. It's just there as a ceiling. The downward sloping portion is the same exact idea as a limited reserves money market graph, the money market graph. It is showing on a downward sloping portion that whatever is happening to the supply of reserves, like I have here, will change interest rates. And in this example, the policy rate, the federal funds rate. So the downward sloping portion is the same idea as limited reserves. So pretty much this portion, the downward sloping portion, you could just think of it as the money market graph. And this is the downward sloping portion of the DR line is like the money demand line. And the SR line, which stands for supply of reserves, is like the money supply line. So you can kind of think of this portion as the money market graph. And we see in this example, if the supply of reserves were to decrease, which on the money market graph, that'd be the same exact idea as the money supply line decreasing, which usually the Fed uses to fight inflation, contractionary monetary policy. We see this decrease in the money supply driving interest rates up, just like it would on the money market graph. But the point of this graph is to show ample reserves, and that is what the bottom horizontal portion represents, the ample reserves economy, which is what we currently have in our modern world. So when we have our supply of reserves line on the ample reserves portion of the graph, what we notice is if we change the supply of reserves, nothing happens to the policy rate. Illustrating monetary policy doesn't work the same way that it did in limited reserves. We no longer can use open market operations as the primary tool to changing interest rates because that doesn't change interest rates in ample reserves. So when we show money supply of reserves shifts on the ample reserves graph, it's to illustrate the difference between what it would look like on limited reserves, like we have here on the left side graph, versus what it would look like in ample reserves. In a limited reserves, selling bonds to shrink the money supply is very successful at changing interest rates. In an ample reserves graph, selling bonds does change the supply of reserves, but does nothing to change interest rates because now, as I said earlier, the primary tool is the administered rate. So this right here, these two graphs right here is how we're going to show monetary policy and ample reserves. And again, since we're in ample reserves, the supply reserves line needs to be in the bottom horizontal portion, not in the upward sloping portion, because again, that's limited reserves. And what we care about for monetary policy and ample reserves is what we're doing to that administered rate, which again is the interest rate banks get for keeping money in reserves instead of loaning it out, which is now the primary tool of ample reserves. And as I said earlier, in a recession, the Federal Reserve will lower the administered rate, so banks have less incentive to keep money in their vault and they can loan more out. Now, the change on this looks a little funky, and we see it on the left-hand side. We are lowering the administered rate, which is illustrated by this downward portion of the graph, demand for reserves decreasing. So we're decreasing this bottom ample reserves portion of the graph, and we notice that that on the y-axis decreases the policy rate as well. So in a nutshell, lowering the administered rate will lower the policy rate, aka the federal funds rate. So in ample reserves, changing the administered rate is the thing that affects interest rates instead of changing open market operations. So by lowering it, interest rates are lower. If interest rates are lower, think of the investment demand, gross private investment goes up. If gross private investment of GDP goes up, aggregate demand increases, and we are growing the economy out of recession. And on the aggregate model, it would look identical to expansionary monetary policy in a limited reserves. The aggregate model looks the same, whether it's limited or ample. It's just the money graph that's changed. Now we're looking at a reserves graph instead of the money market graph. Where in inflation, if the Federal Reserve were to raise the administered rate, this would increase this downward ample reserves portion, and that in effect will increase the policy rate. So in a nutshell, it gives banks more incentive to keep money in their vault instead of lending it out. So the demand for reserves increases in the ample reserves portion. That ends up driving up the federal funds rate, which is again the interest rate that banks use when borrowing from one another, which will decrease gross private investment, decrease aggregate demand, and shrink our economy out of inflation. And that is what's illustrated on this downward portion of the graph with DR going up, PR going up, to PR2, and that's what's important. Now, when we do this, nothing's happening in the limited reserves portion. That's why the upward sloping portion isn't changing at all, because this is only in an ample reserves that this is relevant. So that's why this middle portion of this graph doesn't change when we change the administered rate. And then the discount rate we notice is changing when we're changing the administered rate. So the Federal Reserve keeps the discount rate in proportion to the administered rate and the federal funds rate. It's still the ceiling, but in a recession, they will usually proportionally lower the discount rate like they did the administered rate, or raise the discount rate like they did the administered rate. So the arrows on the upward portion, on the discount rate portion of the demand for reserves line, is to show how the ceiling, it's still the highest interest rate in the economy, but that changes proportionally with the administered rate. So the really most important thing about this graph is what's happening on the bottom portion, because that is illustrating the administered rate affecting not just how much banks keep in their vault, but affecting what the target federal funds rate is, also known as the policy rate. And that is what affects the I of GDP. Just like in limited reserves, it's just a different process of what affects the I of GDP. In limited reserves, it was open market operations affecting nominal interest rates. In ample reserves, it's the administered rate affecting the federal funds rate, also known as the policy rate. And that is how ample reserves work. And College Board will ask both. And usually in questions, it'll say we are in a limited reserve system or we are in an ample reserve system to help you distinguish. Other key things, if it talks about bonds for monetary policy, most likely it's limited reserves. If it talks about the administered rate, most likely it's ample reserves. But they can ask about both the money market graph or the reserves market graph, and they can ask questions about both the tools of limited reserves and the tools of ample reserves. So you now need to know that, plus policy rate and federal funds rate are now going to be used interchangeably. So those are the changes of monetary policy. This does not change my previous videos. That still applies because we are still covering a limited reserve system. You just have to know this as well as the limited reserve system. All right, guys, hopefully this is helpful, and happy studying.